we leave time at the Oh, we want to leave time at the end for questions. So what I'm going to ask is that if you have any questions, please put them in the chat, or you can hold them to the end and we'll call on everybody and have them come off of mute. That's usually the best way to handle the questions, because we do have a lot of content. So we'll go ahead and do that. So I am Jen Vail. I'm the Director of Professional Learning with Civitas Strategies. And Civitas Strategies, we work with childcare providers all across the nation to help them have a better understanding of their taxes so that they can have a great educated conversation with a tax preparer. So I am not a tax preparer myself. I have received education to be able to help you and answer some of your questions. So we've got a lot of good things tonight. I want to thank the National Association for Family Childcare for having Civitas Strategies here this evening. We love meeting with family child care, and I hope you are able to take away some great information. So before we begin, just a quick disclaimer that keep in mind this presentation is for educational purposes. It is not meant to be taken as legal or tax advice. The information that's contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and the recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. All right, so you are joining this, basically the NAFC, NFCC, I apologize, is holding this webinar at the perfect time, right? We still have a month to go to file our taxes if you haven't filed for an extension. So this is a great time. And again, right, I want to educate you so they have a really good understanding of how childcare taxes work. So what are we going to go over today? Well, today, we're basically going to make sure we're going to cover some very important tax topics, and it's to help you run your business in your taxes, but also year round, right? So we should never not be thinking about taxes, all right? So we're going to talk about why you should think about your taxes throughout the year, not just that period from January 1st to April 15th, but why do we talk about those all through the year? What we're going to do, we're going to talk a little bit about tax mitigation. So how could we potentially lower our taxes a little bit? There's actually I don't know if it's a surprise, but I have something for you that actually could lower your 2024 taxes. It's the only thing that you could use to do that. So we'll talk about that. I want to go over what is the Schedule C. I want you to become really, really familiar with that. And we are going to talk about preparing for tax season in terms of some different tools that you can use. We're going to refer to several different websites throughout. I'm going to attach a document with all of the links, so you'll be able to refer to that. But I'll also will give Jocelyn the actual link herself, and they could send them out to you. So I'm going to give it a second while everybody mutes, just to make sure everybody is muted.
You go too fast.
All right, there we go. Thanks so much there. All right, so we've got a lot to go over today because the goal is to provide you with tax knowledge so that you can optimize your filing, minimize headaches, right, when tax season, just like now. And what you learn now, you're going to be able to use in future years. So we like to let you know this is something that you're going to learn and you're going to take it forward in your business year after year. So everyone says, well, other than that January to April 15th, why should I care about my taxes? So keep in mind, it is the responsibility of every business to pay their fair share of taxes, right? We are not debating that. But when you properly prepare your taxes, you actually can potentially recapture hard-earned profit, keep more money in your pocket. So properly prepared taxes can help you retain profit. And what we want to do is have you understand allowable expenses, because that results in legitimately highlighting the word legitimately, paying less taxes and retaining more profit. Now, another reason that we want you to care about your taxes is so that you can mitigate risk. So education, like we're going to do here this evening, is key when it comes to understanding allowable expenses and properly preparing your taxes. So the more that you're aware of tax rules and how they apply to childcare businesses, the less likely you are to perhaps trigger an audit with the IRS, because audits with the IRS are time consuming. They can be expensive. They're very, very stressful, right? So we want to mitigate that risk there. Sometimes audits result in you having to pay money that you hadn't prepared to pay. So we want to avoid that, right? At all costs there. Taxes also are a fantastic way to really get an understanding of your business's health. So when you review your taxes, you have a really accurate way of looking at your profit. So you're understanding the financial position that your business is in, and it can help you plan for changes going into the future. And we all want to know that. And then, so important, understanding your taxes does help build business confidence, because knowledge is key, right? So having the confidence in knowing that you have properly claimed your deductions, that you've met your tax obligation, that removes the factor of the unknown. It allows you to operate understanding that, hey, I'm following the rules of the IRS, right? So I'm unlikely to have any problems going into the future. And that is really, really important. We also want you to be able to understand your taxes so that when you go to a tax preparer, you know the questions to ask. You've got the information, because it is a somewhat of a, it's very unsettling that family child care providers across the United States struggle with finding qualified tax preparers. There's no doubt about it. If you've had any difficulty finding a tax preparer, understand that is the case nationwide, because there is no database for family child care tax preparers. So you're not alone if you're struggling in finding someone. But what we want to do is give you enough information so that you could go to a tax preparer and say, hey, I understand this. I understand business use of home. I understand how the Schedule C works, right? I want you to be an expert. So that's what we're going to talk about today, right? So Civitas strategies, as I mentioned, we work with child care providers across the nation around their taxes, tax education, tax assessment, again, not preparers, but basically helping child care providers get a real good understanding of their taxes. And we've been doing that since 2020, so for 5 years now. When we started, we basically uncovered some pretty concerning information that then allowed us to build the tax education that we have today. So in the very beginning, we would have groups of providers, and we found some information out about their taxes, right? It led us to some research that was, boy, we were upset for the providers, right? We were really concerned. So you'll see this in this first bullet here. The first little group that we worked on, 83% of home-based childcare providers didn't claim the business use of home, right? So that's what you're filing once you see your taxes. We're going to talk about Schedule C today, but also there's a form called 8829, business use of home. We found that 83% of the providers that we worked with didn't know about that. They honestly didn't. The expenses that you take for business use of home, you are the only businesses in the United States that can use business use of home on taxes in this way. So you really, we want you to take advantage of that, because you're do that, right? It's one of the wonderful things about being a family child care provider is you can take a portion of your home expenses on your taxes because you're operating your business through your home. But when we spoke to these providers and we looked over their taxes, 83% of them weren't doing that. So that's very concerning, right? The next one, I believe people think that I'm making this up, and I wish I was. So we actually had situations where tax preparers billed out all of the income, all of the revenue on a Schedule C, and then took that number and put it down at the end as their as what they're going to pay their self-employment tax on. no expenses. Now, how crazy is that, right? Because there is no way that a business does not have business expenses. They'll vary from year to year. Maybe you'll have some years where you won't have a heck of a lot of expenses, but you'll always have business expenses. Some of them are 100%, some of them are shared with your home, but there's no reason to not have expenses, right? And the Schedule C, you'll see where those 100% expenses are listed and that the 8829. These are all things that you can discuss with your tax preparer. So let's face it, there are a lot of expenses that you can claim that you're entitled to. One of the other things that we saw are that childcare providers were claiming, those that were claiming expenses, were claiming expenses that weren't possibly legitimate, or we found things. It was not done in any type of, nobody was lying, but there were expenses on their taxes that would raise an audit every single time. So some really concerning things. And then what else we found is that there were some providers that had allowable expenses, allowable deductions, but they were either miscategorized, so put in the wrong place on the tax form, or they were incorrectly calculated. And that can trigger an audit, right? So there's a very simple little error that we find over and over and over again. There's a line on the Schedule C that is for, it says it's for business meals. It's not referring to the food for the children. It's referring to meals that you would have if you were traveling to a conference or some type of continuing education. A lot of times we would see the children, the food expense for the children put there. That's a huge red flag. So, just kind of keeping that in mind, we saw some things that definitely needed to be addressed. So once we had done this, it really allowed us to have a good understanding of what family child care providers were experiencing with their taxes, and then to go forward, right? Because understanding the proper preparation of your taxes is honestly going to maximize your expenses, minimize your liability, right? So we want you to avoid unnecessary risks, but I also want you to be able to take the expenses that you're allowed. There's a reason you're allowed those expenses, and we want to make sure you're not missing any of them. So the first thing we're going to do is we're going to look at this tax form that is Schedule C. So we'll look at Schedule C. Schedule C is the business portion of your taxes if you are a sole proprietor or a single member LLC. This is the form that you will be filing on. All of your business expenses end up on the Schedule C. And at the bottom of the Schedule C, after you've taken all your revenue, all your expenses, and come up with your profit, the number on line 31 of the Schedule C is where you pay your self-employment tax. So it's where you pay that 15.3% tax. And then that same amount that's on line 31 of the Schedule C gets carried over to your personal 1040 tax form. So basically, the Schedule C is, there's two important tax documents, and this is one of them. This is the one where everything altogether gets reported for your business. You could have things like depreciation, and you could have other schedules in certain instances, but we'll look at the Schedule C next, because this is something that you should be really familiar with. And I would love it if after tonight you would take out a previous year tax return and look at the Schedule C and see how it's laid out. There'll be things that we'll talk about tonight that will be very familiar to you when you look at your Schedule C. Now, I do just want to bring up that if you have several businesses and they're not similar, so let's say I've got my childcare business, obviously, but I also deliver for DoorDash, or have an Etsy shop or something like that. Those would actually require separate Schedule Cs. So when you have different businesses, it is recommended that you file separate Schedule Cs for all of the businesses individually. All right. So let's just look at that Schedule C, because it's very, very it's concise, it's easy to read, easy to understand. So that first part in pink is part 1. And that is where all of your revenue goes, right? So that's every single dollar that you made for the business in this instance, right, in 2024. It means that you're going to include all of the tuition payments, any subsidy payments you receive, anything you receive from the CACFP, from the food program, payments that you received via any of the payment apps. There's a change in the rule around payment apps, around receiving 1099s for payment apps, but just you always needed to claim that income, that revenue. It's not just because now you may be receiving a 1099 for that. You were always supposed to claim that revenue, as well as cash. So part one, you're going to put every single dollar that you earned. And then we get to go to part two, and this is the fun part, right? Because we get to look at all of our business expenses. This is where those business expenses are reported. All right. I want you to become very, very acquainted with this. So when you pull out that Schedule C and you take a look, you're going to see so many expenses that you could take. Not all of those will be applicable for every business. So when you look at your Schedule C, if you see empty boxes, there's possibly nothing wrong, because every business is different in terms of expenses that they could take. But there are some expenses that I would expect every business to have. And we're going to talk about a tool that you can use to help you identify expenses. There's an amazing guide that we're going to talk about next. But so all of these expenses, boom, here they are in part two. And the business use of home expenses, right, which are the shared portion of your utilities, your property tax, your homeowner's insurance, a percentage of that when you use time space, that all gets calculated on Form 8829, and it gets carried over to the Schedule C. So everything is going to be there. That last part that's in green, that's where your profit is calculated. So all of that revenue that you took in that reddish pink area, and all of those expenses that you entered in the green area, when we deduct those expenses from the revenue, that's your profit. That's what ends up on line 31 of the Schedule C. That, as I mentioned before, is where you end up calculating your self-employment tax. So whatever is on line 31 of your Schedule C, you basically are going to pay 15.3% self-employment tax. That is your business tax. That's your self-employment tax as a sole proprietor or a single member LLC. Now, that same number on line 31 is also carried over to your personal 1040 form. So the Schedule C is bundled all together with your personal taxes as a sole proprietor or a single member LLC. It's all included. So that number on line 31, you also are adding it to your income, any other income that you have on your 1040, your spouse's income, depending on how you file. So just keep in mind that line 31 is really, really important, right? Because that's where we're going to pay that 15.3% self-employment tax. And what are we always looking to do? To claim all legitimate expenses so that we can have an accurate and legitimate number on line 31, right? We're looking for accuracy. We are looking to only claim the expenses that we're allowed, but we want to claim all of the expenses that we are allowed. One thing that may happen, and you may need to speak to a financial professional, is everybody tries, very, very hard to lower that number on line for 31, right? They want to pay as little self-employment taxes as possible. But as sole proprietors or single member LLCs, the Schedule C is often what you would show a loan officer if you were trying to get a mortgage. So what happens is if we have a really low number on line 31, year after year after year, a mortgage broker may say, wait a second, you don't you really might not that you don't, but maybe you don't qualify for a mortgage. So I like you to speak to tax professionals and financial professionals about what type of strategy you could use in those circumstances, all right? Because the last thing we want anybody to do is for a number to be reflected there that could potentially keep them from getting a loan that they need. You still want to take all of your allowable expenses. There may be some situations where you're taking something that could have been depreciated. I'm not going to go into depreciation tonight, but there are strategies, right, that a tax professional or financial advisor could help you with. So just kind of keeping that in mind. So
I
what
gotta
we're going
listen
to
to
do
this
is
first, and
let's
then it'll be more.
switch our gears, and let's talk about what we're going to do to proactively prepare for tax season. So
Huh?
we obviously want to
Yeah, I
be,
do it
if
online.
everybody doesn't mind muting themselves, thanks. So what do we want to do? Well, we want to use this resource. All right, so this resource, it's a long title, Preparing for Tax Season, a guide for home-based child care providers. Civitas Strategies puts this together and updates it every year. This year, we're sponsored by Playground. And this is an essential, really an essential tool, an essential guide for family child care. It's been created to help family child care walk through their taxes. So the idea being is let's, optimize the way that even if you're not preparing your taxes, the way your taxes are going to be prepared. Let's maximize those deductions. Let's make sure that we are covering everything that we need. And I am going to put the links for this in the chat. I'm going to attach a document with the links. So what's included in this guide? Well, things that you are going to need for record keeping. So best practices, how you track your income, your expenses, your automobile mileage, business use of home. It walks you through how those areas are tracked if you need them. If you may have apps or you may have systems that you use to track that already. But if you needed it, this will help you gather the resources that you need and have record keeping practices, right? If we haven't been doing great record keeping practices, which are key to the best type of tax preparation, this is the time to do it so that we're ready for our 2025 taxes. Right? We don't have to scramble. That's the idea behind that. So a few other things, there's a lot in this guide. We just discussed the Schedule C. Well, this will go into a little more depth on the Schedule C. So it'll show you up close where you record the income and where you record the expenses. It also will list so many of the allowable expenses for family child care. So you could take this guide and just kind of check them off, right? Oh, I claim that, I claim that. Wait, why didn't my tax preparer claim that? I know I had that expense, or I know I have that expense this year. Better find those receipts. So you can go ahead and use the guide looking for those expenses, right? We can kind of walk through and take a look there. Another great thing about the guide is that it has a nice section on business use of home. And it includes how you calculate and document time space percentage. And tonight we're going to talk about time space because often I find I could hold a time space webinar for an organization a couple times during the year and I'll still get attendance because time space can feel a little complicated. What's very nice in the guide, and I'm also going to give you the link, is that the guide does have a link to a calculator to help you with the time space. But today I'm going to walk you through and teach you the actual steps of time space because I want you to have an understanding of how this is calculated there. So it's going to go through on the business use of home and talk about the utilities, all the shared expenses between your business and your home. So everything that you can claim there. So great area for business use of home. As I mentioned, it'll teach you about the record keeping for things like mileage, but there's actually a mileage worksheet if you needed to use it. There are also tons of apps that you can use to track your vehicle's mileage if you needed to. There is a section on depreciation. And what I'm going to say about depreciation is there are a lot of different rules. It's not that it's complicated, but I have to say that it is best left to a tax professional. So when you think about depreciation, please by all means, get a good understanding from the guide, but know that you're most likely going to be speaking to a tax professional. As a homeowner, family-based childcare, I would love for everybody to write down that you're going to speak to your tax preparer to make sure that you have depreciated your home on your taxes. You may have done it years ago. You have to depreciate a home over 39 years, a personal home. If you have never depreciated your home, please speak to a tax preparer. So just write down kind of like, hey, have I depreciated my home? The reason I want you to think about that, and I'm going off on a tangent, folks, but the reason I want you to think about it is because there is a rule that when you sell your home, you actually would have to pay taxes on the amount that you would depreciate, that you would get to take off of your taxes. You pay taxes on that amount whether you depreciated your home or not. So if you come out of this with anything, please, if you own your home and you know it hasn't been depreciated, as a business owner, please speak to your tax professional. So this guide will talk to you about depreciation. Like I said, went on a little tangent there, but that's really, really important for you to know. There's a section on choosing business structure, right? So sole proprietorship versus LLC. What's the difference? Why would I do one over the other? Keeping things like that in mind. So there's a nice section on business structure there. And now that we are finished with 2024, and in the next month, we're going to wrap up these 2024 taxes, there is a section to talk to you about what we're going to do the rest of 2025 to make sure that next year's return is really maximized. So I'm going to take a minute while we're here and look at me just pulling this up instead of having it right in front of me. How bad is that? I am going to attach to the chat, I believe, if I am able to. Let's see here. And this is going to be a document with all of the links. I say that, and then where the heck is the document? It doesn't like this document. One second, folks. Before the end of today, we're going to have that. I'm not sure exactly why we've got this. This might be fine. One second, because I want you to get these, right? And I want you to be able to see them. And if you had to log off early. So I apologize. Usually I have a little bit of help. I'll be attaching that momentarily. So thanks for bearing with me. It's not showing up unfortunately, in my downloads, not sure why. So basically, what is this guide going to do? Well, it's got checklists. It has visual examples. It will walk you through every step of tax preparation and understanding taxes for family child care providers, right? So it is an essential resource. And what I will do is, because it won't let me attach the whole guide or the whole document right now, let's see if it'll let me attach just this link. All right, so there is the link for the English and Spanish for the Preparing for Tax Season guide. So as you can see, I'm pretty passionate about that, right? Because it has so much great information. Now, when it comes to taxes, we all think of taxes as being very, very complicated. Oh, there's so many things to take into consideration with my taxes. At the end of the day, it's about what you made, what you spent, and what is the number left at the end of the day, right? So all of our expenses, all of our revenue, hey, what's left? That's what taxes are about, right? That's not a, I'm sorry, I'm just trying to make sure everybody's muted. That's what taxes at the end of the day, that's what they're about. What did you make? What did you spend? What's left over? So when we're getting ready to do all of this, we're first going to think about how much money did I make, right? So these are the things that we're gathering when we go to our tax preparer. Revenue, how much money did you make? If you have an accounting system or a bookkeeper, this could be very, very easy to get, right? Maybe you've been entering everything in QuickBooks, maybe you have all of that. If you don't, there's a worksheet, there's a link to a live worksheet that you can fill out and basically start entering any type of documentation that you have for income, right? For anything that you took in. In the beginning, I mentioned that, hey, you're going to have to include 1099s, and you receive 1099, the 1099 NEC for the Child and Adult Care Food Program for the CACFP. You receive 1099s often, could be for grant money, could be for subsidies and things like that. So there are 1099s that are going to be added up and put in the revenue section. The payment app question that now is hot that everybody wants to talk about is the rule has changed. We thought it was going to be different for 2024, and they changed it in November 2024 to make it a little friendlier for 2024. So basically, what is going to happen is in 2023, just to back up, you would get a 1099 if you had more than $20,000 in payments through apps. So I'm talking about PayPal, Venmo, Zelle. Zelle is fighting with the IRS about that. But basically, as what do we have? Square, Cash App. In 2023, if you had more than $20,000, you received a 1099. The law changed in 2024. Basically, if you receive more than $5,000 in payments through the app, you would receive a 1099. If in 2020, that's for 2024. For 2025, it drops down to if you receive more than $2,500, you're going to receive a 1099. And then in 2026, it's only $600. Now, what I want everybody to think about is that this isn't something that should be hurting you, because that was revenue you needed to claim all along, whether you got a 1099 or not. But now, just so you know, payment apps are going to send you a 1099, and they're going to send the IRS a 1099 if you meet for 2024 more than $5,000. It's also a great argument for having a personal, let's say personal Venmo account, business Venmo account. And why do I say that? Well, you're going to get a 1099 for everything. It's everything combined. The IRS doesn't, the payment app doesn't know what you used for business, what you received from parents. They don't know that. They don't know what you received from your friends because you went out to lunch. So this is a great time to think about separate payment app accounts. If you have been combining everything and you exceed that $5,000, please speak to a tax professional. I actually don't know how to walk you through the documentation you would need for that separation. It's obviously going to involve receipts and such, but please speak to a tax professional about that. So you've always had to include any income that you received through those payment apps, but now you may get a 1099K and the IRS may get a 1099K. So we also, for revenue, we can go to our bank records. You may have your own documents. Could be if parents are paying in person, you might have little stubs, right, left over from the receipt that you gave them, or copies of receipts themselves. If you have a CCMS, you could be automatically receiving payments that way. So just keep in mind, you're going to look for a lot of documents. This is what if we're doing the art to own taxes, we're going to need those. And if we're going to a tax preparer, we're going to need them. So that's how much money we made. Now, how much money did I spend? There is in that guide a revenue worksheet, little link to a revenue worksheet. And what this is you're basically right. This is where we're thinking about all of those allowable expenses. Okay. So you probably, you could have potentially actually paid people via 1099, right? That's a business expense. Maybe it was somebody who you were contracting to do, it could be work or something of that nature, maybe a music teacher that comes in and you paid them via 1099. Remember, though, the 1099 that you paid people on that expense, right, is allowable. You're going to hold on to that 1099, so you have proof of that expense there. If you are receiving payment from the CACFP, what I'd like you to keep in mind, well, there's two different ways, and we're going to go over them, two different ways that family child care can expense your food. I just like to throw out there that the reimbursement that you receive from the CACFP, which is income, right? All of your food costs are expenses. And if your food expenses happen to be less than the amount of money that the CACFP paid you because you followed every rule, you've done everything, that is okay. So it is okay if you're doing some great shopping to control your expenses and the amount that you spent on food is less than the amount that you received from the CACFP, that's okay. That does not trigger anything as long as those two numbers aren't crazy. But what's the situation there? Well, got to claim that income on on the 1099 NEC that I received from the CACFP, and I'm going to claim the food expenses. So we want the food expenses to kind of equal the CACFP because we want them to kind of basically get wiped out, right? But I just bring up that don't be concerned if you start to do your food expenses and you're like, oh, wait, I received more than this from CACFP. That is okay. All right. So when we're talking about how much money did I spend, right? We need all of the proof, right? So we need the proof that you paid the expense. We need the amount that you paid, the date you paid it, and a description of the item that was purchased, right? So I want you to think about that purchased or service received. We're going to talk about how you can calculate mileage for your vehicle. But like I said, there's a mileage log in here. So it's a spreadsheet with a lot of different tabs at the bottom that you can just go in and fill out if you don't have another means of doing so. That's the link that is in that I put in the chat. So that's the link for the guide. So lots of great information there. So this is a picture of what the expense sheet looks like in that guide, and it walks you through allowable expenses and definitions of those allowable expenses. It's really, really helpful, I have to say. It can help you from missing an allowable expense, and it'll walk you through, and the definitions are great. All right. So if you would like, you can use this, could use the spreadsheet. You also can use this and write down the amount of expenses that you have. You also could just use it as a check sheet. Boom, got those receipts, have these receipts. Oh, forgot I could expense that. Let me go find those receipts. So walking through the guide can be really, really helpful. And it goes through the 100% expenses you could have. It goes through the expenses that are shared between business and home. So lots of things here. What I want you to do is all of that documentation that we talked about, right? Having to have the amount that you paid, the date that you paid, proof that you paid, and where what you bought with that. All of those receipts, please hang on to those for at least 4 years. All right, so I want you to keep them. Some people go to the extent that they've got paper copies and they take pictures, they scan them just so you have 2 different records. It can't hurt, right? So definitely can't hurt. That's basically tax record keeping there. So keeping this in mind, right, you're going to go through every place that you have a receipt or proof of an expense. How much money did I spend? Boom. Section 2 of the Schedule C, that area that was in the green. All right, let's jump over to some categories that we find are often either miscalculated, misunderstood, things of that nature, right? These are areas that we call tricky topics. All right. Transportation, vehicle can be a tricky topic because perhaps you have a vehicle that's used 100% for business. Let me tell you, you're going to have to prove if you're claiming that all of the expense and saying this is 100% for business, you're going to have to document every single business trip that you took, and that has to equal the odometer, has to equal the mileage. Could it be the case? I'm sure there are people that have a vehicle, a family childcare that's just used for the business, but the most common are vehicles that are shared between your personal use and your business use, right? That's the most common. The rules that I want you to keep in mind is what can you claim as a business trip, right? What is it that we can say, hey, I should be able to expense this, right? It needs to be something that's involving the regular course of business. You're going to have to separate out personal use and business use. We're going to look at 2 different methods. It has to be related to the business. So this says child related to business related. That's a little, I don't know, that's a little redundant. But basically, right, think about regular course of business. All right, let's look at a couple examples here. So when it comes to business trips, right, a trip itself could be for both business and personal, but the primary purpose of that trip has to be for business in order for you to claim expenses for that trip. So if you've ever been present for this webinar before, I use the same example, right? So you go to Costco and you have a big list of supplies for the childcare business, but you also saw the pickles that your family likes and you grabbed a jar of pickles. At Costco, it's probably 5 gallons, I don't know, but you grab that jar of pickles. Well, that trip is still for the business, right? The majority of what we were doing was shopping for the business. Oh, and my family got a jar of pickles. Fantastic business trip. But if I was going to the grocery store and I'm doing my own personal grocery shopping, and I see, oh, let's grab a box of wipes or maybe we need some diapers or something, but a single item, all this stuff is personal, 1 or 2 items for the business. That trip is a personal errand, right? So we are not going to be able to claim the expense for that trip. So I want you to think about, why was the trip necessary in the first place? Main purpose is business. Fantastic. We know it's something that we're going to be able to use towards the vehicle expenses that we're allowed to take. All right. If it's personal, we're not going to do that. So when it comes to transportation costs, there are 2 different ways that you can claim the expense of a vehicle used in business. All right. One is called the standard mileage rate. One is the actual expense method. I'm going to jump to the actual expense method first there. So just like it sounds, actual expense method captures all of the costs associated with the vehicle other than a payment. So if you are making a payment on your car, that you own that car and you're making a payment, keep in mind you will not be deducting or including the expense of your payment. You can include the interest that you paid on that loan. If you leased your car, you could include the portion of that which you use for business. But when we talk about actual expenses, we're also talking about tires and repair. We're talking about gas, basically all of the expenses related to the vehicle, except we are not expensing if we have a loan and we are going to own that vehicle. We own that asset. Nope, that's off the table. All right. If it is a vehicle that's only used for business, that and you're retaining it for your ownership, please speak to a tax professional about that, because some people have different trains of thought on that. What we want to do, right, is we want to stick to the rules. We want to stick to what we know. Actual expense requires a lot of record keeping. So what does that look like? Well, we're going to have to track every single mile that our car is used, personal and business. So we can do that on an app, we can do it in a paper log, but basically if we use the car, we are going to go ahead and calculate and write down the mileage for that trip, where we went, what we were doing for both personal and business. Why do we need to do that? Well, when it comes to the amount of the vehicle expense that you can take on your taxes, they need to know, they being the IRS, need to know everything about the mileage that you use that car for, because there's going to be a percentage based on personal and business use that you can take for these actual expenses, right? So if you put a new set of tires on the car, it doesn't mean that if you use actual expense method, it doesn't mean you're going to be able to expense the cost of the tires. You're going to be able to expense the percentage of the cost of those tires, the percentage that your car was used for business. So the pro of using the actual expense method, most of the time you are going to get a higher amount of an expense. So you're going to have a bigger expense write-off, deduction, I'll say, for using the actual expense. But boy, there's a lot of record keeping and you need to be really, really careful with it. So that's the actual expense method. Then there's also what's called the mileage method. And the mileage method is basically calculated on the miles that you drive for business. And the IRS allows you 67 cents a mile for miles driven for business, right? And we defined what business is, regular course of the business, making sure the primary use there. But we are not going to be reimbursed for gas, for the percentage of gas, for a portion of the the portion of the, what do I want to say, vehicle insurance. Slipped by me there. The tires, the maintenance, things like that. Nope, that's 67 cents. Super easy to calculate because you're going to track all of the business trips. But you still need to track the date, the starting odometer, the ending odometer, what the trip was for, where you were going. You're still going to come to do that. And then all of that business mileage gets added up and multiplied by 67 cents. You get 67 cents per mile. But that's it, right? So if you claim the mileage rate, which is easy and a lot of people do it, it's nothing wrong with it. Just know there are no additional expenses that you are going to be claiming. It's 67 cents for the vehicle. And that, so when you decide between actual or the actual expense method or the mileage method, think about the type of expenses you have with your vehicle. The IRS does not let you jump from one to the other year after year. You pick one and stick with it 5 years or so. At that point, then maybe you have a new vehicle, you have something that's changed, and you could switch to another method. But the IRS will look, you cannot jump back and forth between methods. That could trigger an audit. So just keep that in mind. So that's automobiles. Oh, yep. And as you can see that Celestina said Mile IQ, right? That's a great app. I know I can see Yolanda asked about that. I don't get to see the chat very often, so I apologize. But yeah, there are really great apps for tracking mileage. Makes it very, very easy. And I think they're very low cost. I know there's some free versions, but I think they're low cost. So the next tricky topic is food. A couple little interesting things, right? Food for the children in your care is fully deductible. The food costs fully deductible. If you have staff and you have food expense for the staff, you can only claim 50% of the food for the staff. And if your own children are being cared in the program, you're not supposed to claim their food expense at all. So keeping that in mind, how are we going to deduct food costs? Now, probably everybody here is almost an expert on doing this at this point, but let's just go over it in case if maybe you've been doing one method and you would like to do the other. As a family child care, you are able to choose which of the two methods, and you're going to stick with that. We're not jumping back and forth. Just like with automobile, actual, and then what's called the standard meal rate. So actual expenses, it's 100% of the expense of your food cost. Fantastic, right? Absolutely fantastic. What does it mean? Well, if you accept CACFP, you understand that is a great deal of documentation. That pretty much would cover the documentation that you need for actual expenses. So you have to keep pretty much if there's any information that you need to know other than the actual type of food, right? Other than apple, but you would have to track the date, the child, the amount of, well, you'll add the expenses up at the end, the type of meal or snack. Basically, if you accept CACFP, you know how to do this. That documentation there's a lot to it that is very, very similar. So a lot of scrutiny. You're going to be keeping all of your records, but this could allow for a higher expense because it's every single dollar that you spend on food. Family child care can, if you do not want to get into all of the that type of documentation, although there is still documentation, you basically can use what's called the standard rate method. And the standard rate method uses tier 1 of the CACFP, regardless of whether you participate in the CACFP. It basically tells you how much you are allowed to expense per meal, per snack, how many snacks a day, how many meals a day. You're following those types of, actually, I apologize. When it comes to the standard rate, CACFP, just messed that one up. CACFP has this very, very strict, 2 meals and a snack. However, if you're doing the standard rate, you're going to grab that rate from tier 1, and you are allowed to expense 3 meals and 2 snacks, or 3 snacks and 2 meals. So that's a little different than the CACFP, but we're going to get the standard meal rate from tier 1 of the CACFP. Little easier record keeping, but still writing the date, the name of the child, and the type of meal. All right, we're still recording all of that. And in both methods, we are going to make sure that we are keeping proof that we bought food. We're still keeping receipts, right? We're not just throwing the receipts out the window. Nope, we're still keeping receipts. So you do have to still do recording, but not as much as the actual expense method. But for many family child care providers, the actual expense method is going to get you a larger, allow you to claim a larger expense. For many, maybe not all. So again, we're going to pick one and we're going to stick with it. Again, they recommend 5 years, stay with it 5 years. So keep that in mind here. Now, the next tricky topic does all come back to business use of home, right? Remember in the very, very beginning, I talked about how we saw providers who never claimed business use of home expenses. That's crazy, right? If you were running a childcare business out of your home, you have shared expenses. How are we going to figure them out? Most of you know we're going to use the time-space calculation for any expenses that we have related to the shared use of the home. But there's also something about exclusive use. So what this comes down to is the first thing you're going to do to determine how much of a shared expense you're going to be allowed to claim on your taxes for these expenses that are shared between your personal use and your home is we have to determine what the space that we are using for childcare, is it exclusive use, meaning only used for the childcare? My family does not use that space at all. Or is it regular use of space? And regular use of space is space that's used by the children in my care, but also by my family. It doesn't have to be regular use space, doesn't have to be every single day, every hour of the day, but it needs to be on a regular basis. Right? You want to do that there. I will tell you that when we go to do the time space calculation, exclusive space, right? Exclusive use, expenses there in that space are 100% deductible. When we calculate the time space percentage that we're going to use, the amount of exclusive use space that we have actually gets us a higher time space percentage. All right. So be judicious, measure or count that exclusive use space, but also regular use space, and be honest in the way that you're using that space. If you had an area in the, let's say the basement, childcare, great, boom. Oh, but my son also uses the treadmill in the corner. Guess what? Regular use space. Seems crazy. That's the case. So we'll look at a couple of examples here just so you can get the idea of exclusive space versus regular use space. And in some instances, we're talking about the physical space. And in other instances, we could be talking about the items used in the childcare, because you'll see we'll talk about also not just measuring the physical space, but if you have an expense that involves regular use or exclusive use, right? So if I had a basement and the basement was only used for childcare, the entrance was only used for childcare, exclusive use space. I'm going to measure that space, exclusive use. If I have an area in my home where I'm storing toys and nothing personal goes in there, children's toys only, I'm going to measure that storage space. If children nap in my family bedrooms, right? So my kids are, everybody's out of the house and the children get put down for a nap in the family bedrooms, regular use space, right? Because it's being shared between the business and it's being shared for home use. If this is another example, is if the children are usually in another area of the house, but it's easy to have, let's say, music lessons, or in this case, they're showing STEM learning in your living room, great, regular use space. It's shared between your home and your business. So keeping in mind, right, when we think about costs, costs can be either fully deductible or partially deductible. So here are some examples of costs that would be fully deductible, right? 100% deduction. Exclusive use, right? So if you have an expense in an exclusive use area, that's going to be fully deductible. Some examples are replacing a tile in a basement that's only used for childcare, installing a child-sized toilet, and liability insurance, not homeowners insurance, but your liability insurance that's for the business. That's an allowable, 100% allowable expense. So just keeping in mind that that happens, we're showing a little bit of two different things. We're talking about space, but we're also talking about some expenses, just so that you have a good understanding. Partially deductible are expenses that you have around a regular use space. So common area improvements are the examples that we're going to give. Basically, if you were replacing all the windows in your home, and childcare, the area in which you care for children has windows, you're going to be able to use the time space portion for replacing the windows. I want you to think about big things that you're doing, big improvements, big purchases. Just put the word depreciation in the back of your mind. And if you have any of those types of things, you're going to speak to a tax professional about them. But I'd be able to take a percentage of the cost of replacing all of my windows. If I'm repaving my driveway, and that's where families drop off and pick up children, the cost of that, I'm going to be able to take a percentage, use my time space percentage. I'm not allowed to measure that driveway and include it in my time space calculation. So, and we just wanted to give the example that everybody should remember your homeowner's insurance. It is an allowable business use of home expense, but time space is going to apply because we need homeowner's insurance for our personal home and we need it for the business use, right? So this just gives us an idea of that. Now, time space calculation. In the, we have, I'm going to answer the questions at the end. I see I'm going to get myself a little confused, so I apologize. So in that guide, the link that we put in the chat for the tax preparation guide, there's a link in there that takes you to a free time space calculator. But I still want you to understand how time space is done. That calculation is done because, again, you're the expert in your business. Unlike food costs and transportation costs that we need to stick to something year after year after year, it is acceptable for your time space percentage to change in a year because you may be using that space differently, right? You may have had a room that was shared with your family, and then your son goes away to college, and that room becomes part of the child care. It's going to change my time space percentage, all right? So these are 6 easy steps for time space. It might look like a lot there. We're going to run through an example so that I can show you boom, 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 right? So what we need to do is the first thing we're going to do is let's measure the square feet of my regular use space, all of my regular use space. I'm going to measure the length, and I'm going to multiply the length in feet of that space by the width, and I multiply those two together. That's going to give me square feet for that room. I'm going to just add all of those up, measure every room, add them up. Okay, here's the square feet for my regular use space. Fantastic. That's about space, right? So how do we address the percentage of space that our home uses? Well, we take all that regular use space, all that square feet, and we divide it by the number of square feet in our home, the total square feet in our home. And most of us have that somewhere in the records in which when we purchased our home, that's included. If you needed to measure it all, you certainly could, but most of us have that somewhere in our documentation when we purchased our home. And of course, if you put on an addition, you would need to include that if it involves childcare in any way. Square feet that we got for the regular use space, I'm going to divide it by the home's total square feet. Great. That gives me a percentage. I'm going to put that percentage to the side for a second. That's about regular use space. But time space, right? I now need to think about the time that I use that regular use space. So you determine the amount of hours that you use the home for business, and we'll go into how that would work. We're going to do that. We're going to add up for the course of a year, how many hours do I use the home for business? take that number, divide it by the total number of hours in a year, 8,760. That gives me another percentage, right? Well, I put a percentage over to the side. That was my space calculation for regular use space. I want you to take that percentage and this new one for time, multiply them together. That's the time space percentage for your regular use space. But we have to think about exclusive use space. So just like we do with regular use, we're going to measure all of that exclusive use, business only, childcare only space that we have, square feet, add them all up together. And again, we're going to take that number and we're going to divide it by the total square feet in our home. That gives me the percentage of space in my home used for exclusive use. So that's another percentage. What we get to do is we get to add that percentage of exclusive use space with the percentage of time space for regular use. We add those two numbers together. That's the time space calculation. It's not, and I say, oh, it's not tough. And you say, oh, this lady could say that. Once you start to understand it, it really will make sense. But I also have a link in that guide, right? It's going to help you. But let's use this example just to continue to walk through. In this instance, this business has a home, 1,500 square feet. 500 square feet of that are exclusive use, used only for the childcare business. 700 square feet is regular use space. It's used for the business and it's used for the childcare. How many hours do I use the business in a year? Well, I'm open 10 hours a day and I spend 1 hour before and 1 hour after for prep and cleanup, right? So there's 12 hours a day there. And this particular provider is closed 2 weeks a year for vacation. Let's take a look at what that looks like. All right, so we determined I had 700 square feet of regular use space, 1,500 square feet of my total house. 700 square feet divided by 1,500 square feet gave me 46.6%. We're going to put that to the side, right? We said, okay, that's the space percentage for my regular use space. But now I've got to think about the time. So how many hours was this provider open in a year? Well, 12 hours a day. Remember, 10 hours they're open, hour before for prep, hour after for cleanup. 12 hours a day, open Monday through Friday, multiplied by 5 days, on vacation for 2 weeks. So 50 weeks of the year, 3,000 hours worked over the course of a year. Whew, that's a lot. What am I going to do? I'm going to take that 3,000 hours that I worked. I'm going to divide it by the total number of hours in a year, 8,760. That gives me another percentage. So that percentage is the time percentage portion of my regular use space. I go grab that percentage for the time for space, excuse me, the space for regular use space, and I multiply it by the percentage for time. That, in this particular instance, we had 46.6% of the space calculation. We had 34.2% of the time for the regular use space. I multiply those two percentages together. It gave me 15.9. I think it's 15.99999. I probably should correct this. I think it's 16%. Now I've done that. I've got my time space for my regular use space. But remember, exclusive use gives me a higher time space percentage, which means I'm allowed to claim more of an expense, right? We're allowed to do that. So what am I going to do is I'm going to measure all of that exclusive use space. In our example, that was 500 square feet. I'm going to divide that by the number of square feet in my home, 1,500, 33.3%. I take that 33.3%, the space, exclusive space percentage, and I add to it the time space calculation that I came up with, percentage of 15.9%. Time space of regular use space. We add those two numbers together, and in our example here, 49.2%, and again, I think that should be 599, so that number is probably off just a little bit, but 49.2%, that's my time space percentage. So 49.2% of all of the shared expenses for my home and my business, I'm going to be able to take the legitimate expenses, 49.2%. The utilities, homeowners insurance, property taxes, everything of that nature, right? So 49.2%, That's my time space. Time space isn't difficult. Yes, I've got a calculator that you can click on. Boy, you still have to measure, right? You still have to do all that measuring. But I would love for you to really know the underworkings of how it works and think about on an annual basis, has anything changed? Because maybe there's a whole section of the house that used to be regular use and now is exclusive use. So I want you to think about it. And if it's the opposite, be honest. Yes, it's going to lower the time space. Oddly enough, the IRS has the right to come into your house and measure your space. They can do that. They can actually come in. So one of the reasons why we want to make sure that we have a true and realistic time space calculation. Two things that I see sometimes. 90% of 90% home time space percentage on taxes. Not saying that's not the case. A home may be used very, very little for business, for personal, and tons for business. But if the IRS came in, I'd have to prove to them that that's the case. A lot of times I also see 50%. And the reason I think I see 50% is because a lot of people will say, well, my whole basement's for childcare, half of the house, 50%. And tax preparers will do that. They'll be lazy. They won't get information from you. I'm not putting down tax preparers. I'm just telling you what I've seen is that it's not uncommon for me to see, maybe I get 10 family childcare tax returns and 6 of them are 50%. Well, that's not, the chances of that happening now that you've seen all of the different calculations, the chance of 6 of those providers having a 50% time space, I think it's pretty rare. So the next topic I want to talk about is grant funding. And yes, we're in a situation where we are past all of the stabilization grants, right? We're past all of the pandemic related grants, but grant funding, thank goodness, is in other ways is still going to exist. State grant funding, organizational grant funding. It's not, let's fingers crossed, right? There's always going to be grants that we can get. Maybe not as many, but still things we can work on. But why am I concerned about grant funding when it comes to taxes? Well, first thing I want you to understand is that almost all grants have to be declared as income. Check the details of your grant to see, do you have a grant that's just an exception, right? So when we receive a grant, we know, we have a pretty good idea that is going to be included in our revenue. And you say, oh, that's going to drive up, well, I'm not even going to take that grant because it's going to drive my taxes up. It actually, you're never going to be paying more in taxes than you are in that grant money. And that's because the tax system in the United States is actually it's steps, we'll put it that way. It's steps. Yes, there's taxes to be paid on grant money, but for most grants, there are expenses that are allowable business expenses, right? So I have to claim the revenue of that grant, but I also get to deduct all the allowable expenses. So you could have instances where those two things kind of clear themselves out, right? I want to look at 3 examples so that you can see how that might, the first example is how that is the case. In 1 year, this person got $10,000 in grant money. They had $10,000 of allowable expenses covered by the grant money, and that didn't increase their taxable income at all, right? Those two things, they counteracted each other. Boom, they evened it out. No additional taxes for grants because they had the same amount of expenses. But timing plays a huge role in what you can expense. So in this particular situation, this provider got $10,000 in grant funding, but that tax year only had $5,000 in allowable expenses. So I've got to claim $10,000 in revenue, but when it comes to my expenses, I only had $5,000. So that means I'm going to be paying taxes on $5,000. The next example is something I want everybody to think of. And again, accept grants, as long as you have the expenses to cover them, so as long as you can meet the requirements of a grant that you truly qualify for it, but don't turn down grant money thinking that your taxes are going to be higher than the grant money. A CPA can show you exactly how marginal tax rates, how that works in the United States, where that won't be the case. But here's something I want you to think about. If you take a grant, you accept a grant, and you get the money in a tax year, and that grant lets you basically pay yourself back for expenses that you had the previous year. That's what happened with stabilization funds. So we would get money in 2022, and turns out we could use them all the way back for expenses that we had, let's say, 2020 or 2021. We paid ourselves back. We already had that expense, and now the grant is saying, hey, that stabilization funding is saying, hey, we can use that to pay ourselves back for those allowable expenses. Well, those allowable expenses in, let's say, 22, 23, or those allowable expenses came off that year's taxes, right? So, but I got the grant money this year, so I was allowed to pay myself back, but I don't have those expenses to claim on my taxes. So that's this last example, right? I got $10,000 of revenue in 2024. Oops, the $10,000 of expenses were in 2023. I'm going to be paying taxes on all $10,000. Again, trust me, the grant is higher than the taxes that you're going to pay, but it definitely increased your taxable income. So if you think you're going to be in one of those two last scenarios, right, where, hey, we're not going to be using up all the grant money this year, please put some money aside for increase in taxes. If we're going to receive grant money, but we know we're paying ourselves back for expenses that we've had in the past, you're going to set aside money for your taxes, right? You're going to take some money out of there because you know that you're going to have taxable income. And when I say money out of there, I mean money in general, right? Because we have to use that money for the grants, we have to use it for allowable expenses. But in terms of our income, we're going to work with a professional who tells us, hey, this amount of taxes was due on that $10,000, and we're going to put that aside, and we're not going to have an ugly surprise, right? So please keep these types of scenarios in mind when it comes to grant funding. Now, this is something that I get very excited about, and everybody should tell me to calm down. But is there any way you can mitigate last year's taxes before April 15th? And what I'm referring to is from January 1st to April 15th. Please do not wait till April 15th. This does require some work, but what it means is that usually once a tax year closes, 2024 is done, right? December 31st, no more expenses for me, except when you do this. And what this is if you open a retirement plan through the business, or you make contributions to a retirement plan set up through the business, the amount of that, the amount that the business incurred for those retirement expenses is tax deductible in 2024. So if I owe a lot of money, let's say we're doing our taxes this week, we're like, oh boy, we owe more money than we thought. We could open a retirement account through the business, and we can take money from all that extra profit that we're going to be taxed on, take that money and put it into a retirement account for us, for our future. And that amount of money that we just put towards our future is a tax deduction for the business, because the business was paying your retirement. If you have employees, whatever you have set up for yourself through the business, you have to do the same thing for your employees. And there are many different types of retirement plans. As family child care providers, there's a very good chance that you would actually want to look into a SEP IRA, S-E-P IRA. They're basically no charge to set up. They're very, very easy, easy rules, easy documentation. If you have extra money from 2024, you go do those taxes, it's more money left over on line 31 that we're going to pay our self-employment tax on. Consider opening a retirement plan through the business, taking some of that extra money, paying myself for the future, investing in my future, and getting to take that as an allowable expense. So want everybody to think about that. It's a great opportunity when it comes to retirement. You can go to places like, I'm not I am not promoting one over the other or anything, but Fidelity, Vanguard, Charles Schwab. But sometimes credit unions and banks also have people on staff that can help you set up a retirement account through the business. What I want you to keep in mind is don't wait till April 12th or something. It takes a little time to get these things rolling, right? And we want to make sure that we can use that to lower the 2024 tax liability. So if you're thinking about this, if this is intriguing, reach out to a financial professional who can help you set it up through the business, right? We're not talking about a Roth IRA. We're talking about retirement plans that are opened through the business. So I get excited by this, as you can tell, right? Now, if we ended up with extra money, even after we made our retirement contributions, we had extra money. This isn't about lowering our taxes, but I would like to remind you that these are things you can do with extra tax returns, or if the income, the revenue, the profit, the profit from last year is more than we thought. Think about some things that you could do. We could pay down debt, right? So it's a great opportunity to pay down debt. We could create an emergency/reserve fund, basically helping us have a financial cushion, right? Extra money, great time now to take that money and put it aside. High yield interest savings accounts, talk to your bank about it. It's going to be much more money than just parking it in your checking account or in a normal, I'll say normal, but in a different type of savings account. High yield savings accounts, still worth doing. Investing in business expansion. We've got more money. Hey, we wanted to do a business expansion. This might be the time to do it. So I tell you those three things just to remind you that if you end up paying more taxes than, if you end up with more profit than you thought after taxes, please take that money and put it to good use, right? Be smart with that. Maybe though, it's paying yourself, because maybe you haven't been paying yourself on a regular basis. You have extra money, pay yourself. All right, please, by all means. I also have a little note here, right? Set a time for your mid-year tax review now. Mid-year tax review is basically the time between August and October, where we're going to take a look and make sure that we've paid enough estimated taxes, that we've gathered the correct expenses, we're tracking our revenue. We're using that time period. Put it on the calendar now, grab your phone. Oh, maybe we're going to do the first week of September. And we're going to take a look at some things. We're going to look at estimated taxes. Have we paid enough? Should we up that last estimated tax payment that we make because it looks like we haven't quite paid the amount of taxes that we want to? Are we gathering everything? Hey, are there big purchases? I got a lot more revenue than I thought I was going to have. Are there big purchases, expenses that we could make to lower the tax liability that year? So mid-year tax review. When I say we're thinking about taxes all year round, right? When it comes to tax preparation, I said it right in the very beginning. Family child care across the United States are underserved by tax preparers. It is incredibly difficult to find qualified tax preparers. There's no doubt about it. I will not argue with that. It is a challenge. I can't recommend anyone, right? So in my position, I can't play favorites. But how can you get your taxes prepared, right? One of two ways. Well, we can have that paid preparer. They will guide us as we go. Fantastic. They could be expensive, right? Paid tax preparer, but they're also available for advice perhaps after the fact. So there are benefits to using a paid preparer, especially if they have experience, right? If they have experience, boom, that's great. But self-preparation, and I'm just going to say TurboTax. I have a link for you for a TurboTax guide. It's not that I'm saying, oh, you should use TurboTax, but TurboTax happens to have a very pretty solid operation for family child care, including time, space, and things of that nature. So keep that in mind. So if I do self-preparation, usually that software, those programs, I have to pay extra for guidance. There could potentially be somebody who could help me, but I'm going to pay extra for it. It most of the time is less expensive than a paid preparer. And what's that last line? Can be more accurate? Well, TurboTax is one of them, right? Who understands, it's all set up to understand family child care. And the IRS actually likes, they like tax software. They like that. They feel that there's less of an issue with human error or a tax preparer who doesn't understand how to do childcare taxes. So, okay, paid preparer. Again, we're all talking about this is not easy to find. The first thing I want to say is that please look within your local childcare network. Reach out to other providers. Maybe you're in Facebook groups. Maybe you guys are getting together for coffee. Not that anybody has any spare time, but in some way, maybe you've got a text chain that you're keeping in touch with other family childcare providers. Ask who their tax preparer is. Ask them. If you get a good one, pay it forward and share their name with somebody else, because it is so difficult. All right, just keeping that in mind. When you do find a tax preparer, are they qualified? So all tax preparers have to have what's called a PTIN, and that's the IRS's Preparer Tax Identification Number. They have to register with the IRS. So you can always ask, do they have their PTIN? Do they understand childcare? Have they worked with family childcare before? Do they understand what time space is and business use of home? You now can interview them. You have all the questions, you know everything that you need to know to have a conversation with a tax professional. You're in charge. You're the expert of your business. Interview these folks, right? Don't just go to them. You know what you need on there. If the paid preparer is working with you, please make sure that you could reach them throughout the year if you needed them, because God forbid there was either an audit or the IRS reached out for any reason. You want to be able to get a hold of that paid preparer, and you are entitled to a copy of your return and all of the paperwork that you gave that paid preparer. So you should be getting back not only a hard copy of your return, but also every single piece of paper that you gave them. They don't get to keep anything. They don't need to keep anything. It all comes back to you. Some of them put it in a nice, pretty folder and it's all together. Some of them might put it in a shoebox. I prefer the people that put it in a nice folder. But make sure you're getting a copy. Make sure you're getting all of your information back, because something could happen during the year. Could be a mortgage, or could be something that you need a copy of your return. If you don't have access to it, that can be tough. I'm going to throw this link in the chat. This is for this one is for the TurboTax, the guides. There's an English guide, there's a Spanish guide. So this is a QR code, but I'm going to put the links in the chat. So basically what this is it was designed for family childcare providers to help you with taxes in general, but also TurboTax. Again, I'm not saying TurboTax is the way to go. We just happen to know that it does work well for childcare providers. So I'll say that QR code there, or I am going to put the link in there. You see here, easy to use with your Schedule C. You can do it. You can do it there. This self-assessment, this is actually a way that you can take your Schedule C and kind of use it to see what this year's taxes might be. So, right, fill out the Schedule C. Take a look. What is this going to look like? Am I claiming all of the right expenses? We don't keep any of your results. You get a PDF and then everything disappears. We email you a PDF. Again, I'm going to put this as available in English and Spanish. I'm going to put the link in the chat. That's a QR code. A lot of great information that helps family childcare sole proprietors and single member LLCs. So by all means, please test it out for yourself, and free, right? Go ahead and use that there. What I'm going to do right now is I'm going to take a minute. We are going to take questions, but let's just put those links in the chat while I am thinking about it. All right. And then we're going to go through and we're going to answer questions. All right. If you just wanted to see the revenue worksheet from the guide that we talked about, that we shared those, here is just the revenue worksheet if you wanted to take a look at it. Curious about CACFP reimbursement rates? Been a while since you looked at that. Here we go. And again, I'm going to provide this. I will give this to the NA Why do I keep doing it? NAFCC. Sorry, folks. I apologize about that. So I'm going to give these links to them in an email that they'll get tomorrow from our administration team, and they'll be able to share them with you. What is this here? You're going to see a weird name, Weka. This is another tax app that we have. I want you to use that. I want you to use the time-space calculation tool. I know this. Oops, I should have said that. Let's do this. I'm running out of time, folks. All right. Oh, if you have questions about estimated taxes, go to the IRS website. Let's do that. And just so you know, when we use our own Zoom, Civitas' Zoom, I have somebody here that does this for me. But today, it's nice that the NAFCC, oh my goodness, got a cup of coffee this late in the day. It's very, very nice that they are hosting the Zoom for us. So that means my support people, they're not with me. Those are the TurboTax guides, and we're almost done, and we're almost ready to take some questions. I would love for you to take a look at, oh, I don't like that one. I'm sorry. I would like for you to take a look at the proactive tax planning tool. So this is from the Civitas Strategies, our website. So, all right. There we go. So we are going to answer questions, but what I am going to do is I'm just going to advance to the slide. Oops, excuse me. Oh my goodness. What am I doing here? Why do I not know what I'm doing? Boom, there we go. Civitas Strategies, many of you know who Tom Copeland is. Tom retired, and when he retired, Civitas Strategies, the company that I work for, we became the stewards of Tom Copeland's blog. We are constantly updating with new information. If you have questions after the fact, right, you go through this, something happens next week, you have a question, please go to the blog, and you can search through the blog and look for the information that you need. There is also a little button there that says Ask the Experts. Please enter questions if you can't find the answers. And in the next week or so, I'm going to be recording a video with all of the answers. I'm trying to keep up with taxes this year. So having said that, let's take a look. Jocelyn, do you want to read me any questions from the chat?
Sure, let me.
Oh, I see something here. So Alicia Ringgold, how do I go about getting my husband's W-2 if his company declared bankruptcy? Oh my goodness. Don't know. I wonder if Violetta is on this call. Violetta is a tax expert. Violetta, any idea how somebody goes about with the W-2s? Could you get that from federal? I don't know.
I think you could go into your own. I know that I've gone through my own account with the IRS, and you can see, you know, if they have given them, you know, the wages.
Oh, fantastic. I like that. And I think a lot of, you know, now, right, a lot of so many of our businesses pay us. We have apps for ADP or something like that. Unfortunately, we can get all of those records there. But let's just see what else I have there. Anything there? All right. Let's just look. I just want to look at this resource here.
Because
okay, so the IRS actually can help you. All right. So publication 4128, impact of job loss has, and we're going to throw that in the chat. All right. Oops, I see that I don't want to get into a direct message. I want to do group chat. All right. So for that particular situation, please, by all means, go ahead and reach out to the IRS, and they can walk you through how you're going to get that W-2. So thank you. All right. I'm going back up to the questions here.
Okay. Right. Monica says, what if you have received grant money and did not receive a 1099 for it? Do you still claim, or if so, how?
Yeah, so you still have to claim that. So if you received grant money and did not receive a 1099, what you would like to do is take most grants have a significant amount of paperwork, right, that show what that payment was. Or you have record of the automatic deposit, you have a canceled, not canceled check, you wouldn't have a canceled check, but you have a picture from your bank that you deposited a check. You're going to have to use that number. That is being reported to the IRS, even if they didn't send you a 1099. All right. What else do we have going? Let's see.
Do you have a sheet that shows the amount allowed per year for meals or food served to the children?
Is the CACFP in there? Yes. So the CACFP, the link that's in the chat, that's where you can go and find all of that information. There's a lot there, an absolute lot there. So you can find. Oh, I have a message here to please put the guide in the chat again. So I will do that in just a moment. All right. Yep, so the amount of foods allowed per year per meals, you'll find that in the CACFP there. Does that also include a Roth IRA? So Roth IRAs are not open through the business. Other kinds of IRAs are. Roth IRAs are your private tax investments. What's great about those is that you're paying for those with post-tax dollars, and when all that interest, everything's going to compound and grow, and when you get your money from your Roth IRA, no additional taxes. SEP IRA, you're going to be basically putting in pre-tax money, and when you take your distributions from that, just like a 401k, you'll pay taxes at that time. Great strategy to have both. All right. Let's see here. Sorry, just kind of going through. Is it okay to change different tax experts every year? Absolutely. The IRS is not looking at who is preparing your taxes. So keep going till you find a good one, right? Keep going till you find somebody who understands family childcare. And once you found them, share them with somebody. So how do I get a 1099 from Venmo? So keep in mind, before this year, in 2023, you had to have $20,000 in Venmo payments to get a 1099. And then this year, 2020, for 2024 taxes, it's $5,000. But all of the apps have a way that you can access tax documents. So if you go into your Venmo app on your phone, if there's a tax document that's been issued to you, it'll be in the app. What if you got overpayment from child care account? UN's payment came back. I think, Billy Joe, I think I'm going to need just a little more information, hon. I'm sorry. Can you just fill me in? Come off mute. And Jocelyn, are we okay that we ran over?
Yes, ma'am, it's
Okay.
fine.
Okay, just I didn't know if we had, if Billy Joe, if you're still here.
I'm here.
Okay, great. What's happening, Billy Joe?
Okay, so I got overpaid on the child care account and
okay.
from back in 2022, and they until like 2023, part like 6 months of it. Because supposedly I hit nighttime care on some of my kids, and I don't know how I did it because of them kids don't come here in the morning that early.
Okay.
They come here like 8 o'clock and they're gone for school. So I don't know how I did it, but I had paid money back. But I mean, it was a nice good chunk I had to pay back. So can I claim that back on my taxes? Because I paid it once on taxes, then I repay again.
So you did. So we got that money. We paid taxes on it.
Yep.
We had to pay it again. Speak to a tax preparer, but I'm going to say you're in luck. Okay.
Right.
But please speak to a tax preparer. Yeah. So I don't know the intricacies of how that's going to work, but
because I know I'm not the only one who had to pay money back. I mean, I live in Wisconsin. I know at least 10 of them that had to pay money back.
So, again, right, you were taxed on it to begin with.
Right.
Paying that money back is an expense because you received the money already, right?
Right,
so,
yeah.
Yeah, so, but please speak to a tax preparer so that is all properly documented. And I don't know where that's reflected on your taxes, so I apologize.
Okay.
Thanks there. And here's can you have a Roth IRA and a SEP IRA at the same time? Absolutely. I love that strategy. One is post-tax dollars, one is pre-tax dollars. Having a mix, great retirement strategy. Now, do we have any hands up, Jocelyn? Anybody who want to have a question, come off mute. And if not, we are going to be done for tonight.
I don't see any more hands.
Okay, great. I'm going to encourage everybody, if you love YouTube, go to YouTube and look for Civitas Strategies. You can subscribe to our channel, over 600 videos there. Actually, I have a QR code for that. Our website is civstrat.com, abbreviation there. But if we don't have anything else, then we are done for tonight. I want to thank you all for having us. It was a pleasure to meet with all of you, and good luck on your taxes. You guys can do this, right? You're the experts, so you can do this.
I'm sorry to clarify, did you say that the tax turbo was free?